As we have said before, a balance sheet is a statement that shows what the company owns and owes. Every balance sheet has two sides. On one side are the company's assets, what the company owns, and on the other side are the company's liabilities and equity, what the company owes. It is important to remember that assets stand on the left and liabilities and equity are on the right side. In this lesson, we will describe the main asset, liability, and equity accounts. Our goal is to understand how these accounts contribute to the company's business cycle and the nature of the items that these accounts describe. Let's start on the assets side. The cash account is one of the most important drivers for a business. It shows how much of the firm's assets are cash or can easily be converted into cash. It gives us an idea of the liquidity of the company. We know very well that a business cannot function properly if sufficient cash is not available for its day-to-day operations. The next important item that we will see on the asset side is accounts receivable, also known as trade receivables. When customers buy a firm's products, they have to pay for them, right? And until they do, the firm will register this amount in accounts receivable, which indicates the money owed by customers. The firm registers that it has earned a payment from these customers, but has not yet received the payment. Inventory is the account that shows the value of raw materials, goods that are in the process of elaboration, and finished goods that are ready to be sold to customers. The company has all of these goods in its warehouse. Finished goods are products that can be immediately shipped to customers, while raw materials and work-in-progress goods require additional processing. Property, plant, and equipment are a group of assets that are vital to business operations. Imagine a production company. It certainly needs plants and equipment in order to transform raw materials into finished products. Usually, this is a hefty investment that cannot be easily liquidated. The value of property, plant, and equipment is reduced each year, or should we say depreciated, in order to account for the fact that the asset will be obsolete after its useful economic life ends. These are some of the main types of assets that we will see in financial statements. Let's focus our attention on the liability side. Accounts payable are certainly one of the most important items on the liability side. When a company buys raw materials for its production process, it registers the amount in accounts payable until the actual payment has been made. The firm owes its supplier a given amount of money because it received the goods. Financial liabilities are a significant item for a lot of businesses out there. A financial liability appears on the balance sheet of a company when it receives external financing, which is usually a bank loan. The firm uses the funds in order to finance its operations and commits to repaying its lender in the future. On the same side of liabilities stand the ownership claims, such as paid-in capital. This is the firm's capital that it technically owes to its owners. This capital would not be repaid to the shareholders, but the company will try to pay them a decent amount of dividends if its business is successful. These are some of the most frequently seen balance sheet items. I am sure that after this lesson, you'll have a better idea of their meaning. We are always open for any questions that you might have, so if you would like to ask something, please don't be shy and post your questions in the discussion board. In our next lesson, we will go a step further, introducing the main accounting equation.